Hello, good morning. We are now on our Financial Accounting Part 3, which is the continuation of Financial Accounting Part 1 and Part 2. It is all about how our financial statements are recorded, how a financial statement are accounted for, no? So in Module 1, we have statement of financial position, revenue from contracts with customers, non-current assets held for sale, and discontinued operation. So these are the three parts of the Module 1. And the learning objectives of this module is, first, we have to enumerate and describe the components of a complete set of financial statements. We have to enumerate and describe the general features of financial statement presentations. Differentiate between the statement of profit and loss and other comprehensive income and the statement of changes in equity. State the 5 steps in recognitions of revenue. Describe how performance obligations are identified in a contract. Describe how transaction price is determined and how is it allocated the performance obligation. State the timing of revenue recognition and its measurement. State the presentations of contracts with customers in the financial position. Describe the requirements for classifying assets as held for sale. State the initial and subsequent measurements of held for sale assets, and state the presentation requirements of a discontinued operation. These are the objectives of this module. Now we go now to the outline of the topics. We have 3: statement of financial positions, or what we call the balance sheet, revenue from contracts with customers, a non-current asset held for sale, and discontinued operation. So we go now to statement of financial positions. As per PAS 1, prescribe the basis for presentation of general purpose financial statement to improve comparability with both the entity's financial statement as previous records and with the financial statements of other entities. We got the complete sets of financial statement. First we have the statement of financial position, and this is sometimes called balance sheet, statement of profit and loss and other comprehensive income. This is what we call what we call the income statement, and the statement of changes in equity, then statement of cash flows, and then the additional. During our time, we have only 4, but as of this generation, we have the notes of comparative information in respect to the preceding period and statement of financial position as at the beginning of the preceding period when an entity applies an accounting policy retrospectively or makes a retrospective restatement of items in its financial statement, or when it is classified items in its financial statement. In short, these are the requirements for a general purpose financial statement. So this is to improve the comparability principle of the financial statement as of the internal or previous years, and with that of the financial statement of other entities that is similar to the operations of the business you are handling for. Then we have the requirements or criteria in presentation. We have 1, fair presentation and compliance with PFRS or Philippine Financial Reporting Standards. The applications of the PFRS with additional disclosure when necessary is presumed to result in financial statement that achieve a fair presentation. Means, if there are proper disclosures and proper the terms or the terms and the presentation as within the PFRS, then it would be we could call it would be comparable with other financial presentation, or it is also, this is for general purpose, even you are not you are not an accountant or you are not an accounting major, because you are using the statement as pair presentation as compliance with PFRS, then it would be easy for them to communicate. Then the second is going concern. An entity is not a going concern if, as of financial reporting date or prior to the date of authorizations of financial statement for issue, management either intends to liquidate the entity or to cease trading, or has no realistic alternative but to do so. So these are it is an assessment of going concern is at least 12 months. So as in our basic accounting, when said to be going concern, means that we always assume that the business is indefinite in operation. So unless the management intends to liquidate or has no realistic alternative but to do so because you are to end or cease your trading. Then the third is accrual basis for accounting. An entity shall prepare its financial statement except for cash flow information using the accrual basis of accounting. So in our basic accounting, when we set to be accrual accounting, we have to consider receivables and payables. But when we are on the cash base, we are only to consider the cash flow. Then next is materiality or aggregation. Each material class of similar items must be presented separately in the financial statement. So the range or the degree of materiality depends upon the relationship of the amount and of the transaction in the whole operation, on the whole operations of the business. Then we have number 5, we have offsetting. Assets and liabilities and income and expense shall not be offset unless required or permitted by a PFRS. So means measuring assets net of valuation allowances. Example, obsolescence, allowances on inventories, allowances for doubtful accounts, on receivables, accumulated depreciation on PPE are not offsetting. So these examples are not offsetting because you are going to present them in the financial statement. So number 6, frequency of reporting. An entity shall present a complete set of financial statements, including comparative information, at least annually. So this is a requirement because annually you are going to file your or renew your license of operation, and the government agencies, which are the SEC, the BIR, the Treasurer's Office, where your business are situated, you have to file your annual report. So at least the requirement is at least annually, unless management will have an interim. So when entity changes the end of its reporting period and present financial statement for a period longer or shorter than 1 year, an entity shall disclose the following. So when you are going to make interim or shorter than 1 year, the notes should be, or the disclosure should be done period covered by the financial statement. That is very important. How many months, how many, is it semi-annually, is it quarterly? Then, the reason for using a longer or shorter period. So, you have to justify why is it 13 months, 14 months, why is it 6 months, or only 3 months, no? The fact that the amounts presented in the financial statements are not entirely comparable. So, you have to disclose when there are some changes, you have to disclose that which part of the financial statement are comparable, which part are not comparable, because you cannot compare different items. Now, comparative information. An entity shall present comparative information in respect of the preceding period for all amounts reported in the current period financial statement unless standard permit or required otherwise. So, you have to check, we have to note this criteria na you could not just compare an information from one period to the other unless they use same standard or same procedure. But if it is, there are changes, then you are going to disclose it. Make a disclosure. The number 8, consistency of presentation. An entity shall retain the presentation and classifications of items in the financial statement from one period to the next. So that is consistency. Unless there is apparent that another presentation or classification will be more appropriate following a significant change in the nature of entity's operation or a review of its financial statement, or a PFRS requires a change in presentation. So, you are going to present it as same period from one period to the other, pero if there are changes or there are requirements by PFRS, then you make some changes. But as I said, any changes that you are going to make, and this is significant in nature that will affect the entity's operation, then you are going to disclose or make full disclosure on all of these changes. So, a statement of financial position at the beginning of the preceding period shall be presented when an entity A applies an accounting policy retrospectively or makes a retrospective restatement of items in its financial statement, or when it reclassifies items in its financial statement and the effect of the event of the state of financial position at the beginning of the preceding period is material. So, again, if there are significant amount or there is a materiality effect of any changes in the reclassification of items, then you are going to disclose whatever changes you are making. Now, the statement of financial positions may be presented in two. We have classified and we have unclassified. When said to be classified, you have to show the current and the non-current assets and liabilities, or if it is unclassified, showing no distinction between current and non-current items. So I think you have learned this in your intermediate part 1 and part 2. For part 1, we have the assets. For part 2, we have the liabilities. I hope you understand and you know the classifications of all of those assets that may be presented in your financial position, whether current, non-current, liabilities, and assets. For our no distinction, then you just make it as you want to present. Now, what are current assets? So, as a review, and to review you for a presentation, a current asset is an entity shall classified as current when you have to expect, it is expected to realize that the assets are intends to sell or consume. It is normal in its operating normal period or cycle, holds the asset primarily for the purpose of trading, expect to realize the asset within 12 months after the reporting period, or the asset is cash or cash equivalent unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. So these are current. So what is within this description? So the asset should be consumed or it could be sold. The asset is within the normal operating cycle, and the purpose of those assets are for trading, and it is, if it is a cash, it is not restricted for being used for the settlement of a liability. So these are current assets. Then we have the current liability. Expect to settle liability within a normal operating cycle. So normal operating cycle usually is 12 months, no? And then the liability primarily for the purpose of trading. So the liability exists because of the trading purposes. And then this liability should be settled within 12 months, and the entity does not have an unconditional right. So there is no unconditional right, or means to say there is no restriction as to the payment of the liability, and which is within 12 months. Currently maturing long-term liabilities. So these are long-term liabilities, but it could be matured within the current operation. As a general rule, currently maturing long-term liabilities are presented as current liability, except refinancing agreement fully completed on or before the balance sheet date. And then these are non-current liability. Refinancing agreement after the balance sheet date, but before the financial statements are authorized for issue, non-current liability if the refinancing is at the discretion of the entity. So these are the exceptions that you could not present the currently maturing long term if they are within these two exceptions to the rule. So they are still be a non-current liability. Breach of loan agreement. As a general rule, a liability that is payable on demand is a current liability. A payable on demand means to say anytime you could pay. An exception is it's presented as non-current liability if the lender provides the entity on or before the balance sheet date a grace period ending at least 12 months after the balance sheet date to rectify a breach of loan covenant. So this is exception. So if it is payable on demand, it is current liability. But if there are agreement by the lender, it means to say there is a grace period given by the lender, then it would be a non-current liability. So what is the presentation? Deferred taxes. So deferred taxes shall be presented as non-current items. It is classified statement of financial position irrespective of their expected dates of reversal. So these are there are minimum line items in the statement of financial position. We have the PPE and equipment, investment property, intangible asset, financial asset excluding amount under E at saka H saka I, no? So we have the investment accounted for using the equity method, the biological asset, the inventories, the trade and other receivable, cash and cash equivalent, assets are held for sales, classified as held for sale in accordance with PFRS 5. So these are some of the minimum line items in the financial statement, which are, in this one, they are presented in the non-current asset. For liability, we have the trade and other payables. We have the provisions for provisions for tax, provisions for any education or funds or contingency funds. So these are the provisions. Financial liabilities excluding amounts shown in under K and L. We have the trade and other provision. So other from this one, the liabilities and assets from current tax defined in PS 12 income taxes, deferred tax liabilities and deferred tax asset PS 12, the liabilities included in disposal groups classified held for sale accordance with PFRS 5, non-controlling interest presented within equity and issued capital and reserve attributable to owners and of the parent. So these are some of the line items in the financial positions. So and K up to P, these are on the liability caption, and then we have the issued capital, these are on the equity section. Then we go now to the order or format of presentation. In PS1 does not prescribe the order or format in which an entity presents items. It prescribes the basis for presentation of general purpose financial statement to improve comparability of both the entity's financial statement of previous period and within the financial statement of other entities. The general purpose financial statement are those intended to serve users who do have the authority to demand financial reports tailored for their own needs. The general purpose financial statements are those statements that cater the most of the common needs of the wide range of external users. The general purpose financial statement are the subject matter of the conceptual framework and the PFRS. So the types of comparability, we have the intra-comparability at saka intercomparability. When we talk on intra, it is within the business. When we talk of intercomparability, it is within the same business in the outside operation. So these are the complete set of financial statement. Again, statement of financial position, statement of profit and loss. We have the income statement, statement of changes in equity, statement of cash flows, and then we have the notes, comparative information with respect to preceding, and statement of financial position at the beginning of the preceding period when entity applies an accounting policy retrospectively or makes a retrospective restatement of items and financial statements and with its classified items in its financial. So again, this is the complete set of financial statements that are needed in the audit and in the general purpose financial statement for government, for management, government, and other users of the financial statement. So again, we have the general purpose, the representation, and then we have the going concern, the accrual base, offsetting, frequency of reporting, comparative information. consistency of presentation, and we got additional statement of financial position. So this has been discussed in the other previous PowerPoint, and we go now to the statement of financial position. We have the classified and classified. We got the current assets, and then current liabilities, then we have the minimum items in the financial position, and then we got now the order format. So in PS1 does not prescribe the order format in which an entity present item, statement of profit and loss, and other comprehensive income. So an entity shall present all items of income and expense recognized in a period. We have the single statement of profit and loss and other comprehensive income, or in two statement of displaying the profit and loss section only, separate statement of profit and loss or income statement. And the second is statement of the beginning of the profit and loss and displaying the components of other comprehensive income. So in basic accounting, we got two presentation. The first, we have the single step, and then we have the comprehensive. If it is single step, we have to present all the revenues minus all the expenses, and we got now the income. In the two statement or the comprehensive, we got to present, or what we call the functional. We have to present section by section, what are the revenues, what are the costs, and what are the operating expenses to arrive at a net income. And then you may display also some other income for a presentation of comprehensive income. We got extraordinary items. In PS1 prohibits the presentation of any items of income expenses as extraordinary items in the statement, presenting profit and loss and other comprehensive income in the notes. So we got other comprehensive income for the period. We got, these are changes in revaluation surplus. So when you change, when you change your valuation, you may have increase. There is an increase of the period, increase in the income, but these are not presented as income in the revaluation. Realized gains and losses on investment in PFOCI, fair value securities, remeasurements of the net defined benefit liability, remeasurement, and then gains and losses arising from translating the financial statement of foreign operation, and then effective portion of gains and losses in hedging in a cash flow hedge. OIC may be presented either net of tax or gross of tax. So these are other comprehensive income for the period. Then classification adjustment for the period, the types of other comprehensive income, reclassification or adjustment. Changes in revaluation, no. Remeasurement, no. Fair value change, yes. Yes. Debt instrument, and for equity instrument, no. Debt instrument, yes. Translation differences on foreign, yes. And then effective portion of cash flow hedge is yes. The total comprehensive income comprises all components of one, profit or loss, and other comprehensive income. Presentation of expenses, nature of expense, method, function of of expense method. So, nature or function. If an entity classified expenses by function, it shall disclose additional information on the nature of expenses. So, when it is by function, you have to disclose whatever information on the nature of expenses. Disclosure of dividends. Dividends declared by an entity are disclosed either in notes or statement of changes in equity. So, when there are dividends, they may be received or they may be given. These are to be disclosed in the notes of financial statement. Order of presentation on disclosure in the notes. So first, statement of compliance with PFRS, summary of significant accounting policy applied, supporting information for items presented in the other financial statement, and other disclosure.